All right, if you learn one thing from tonight's show, you have to know that when something sells off on good news, that's what I call a red flag. Last week, OPEC Plus approved a smaller-than-expected production boost, upping its supply quota by just 100,000 barrels per day. Analysts were looking for something several times higher. So, in response, of course, the price of oil jumped. But it couldn't hold on to those gains into the close and finished the day down a few bucks. Since then, well, it's basically been flat. Didn't do what it was supposed to do. So what the heck is going on here? Tonight, we're going off the charts with the help of our resident commodities expert, Carley Garner, a brilliant technician who's the co-founder of DeCarley Trading and the author of Higher Probability Commodity Trading. Now, remember, she called the exact top in oil. That's why we're back to her. She's been warning us of a commodity bust for months now, including the possibility of much lower oil prices. Is anyone looking for that? Well, 120, everyone thought was going to go to the moon. Not Carley. And after this OPEC meeting, her take is very simple. She thinks OPEC recognizes that we're already seeing global demand destruction for crude. So, of course, they don't want to increase supply too much. Although they'll never declare it publicly, OPEC's a cartel. And all cartels do their best to maximize profits by keeping prices elevated. And at a time when central banks around the world are aggressively raising interest rates in order to hit the brakes on commerce, Garner's betting that OPEC no longer believes the global economy can support $100 crude, which just a few weeks ago we thought was gospel. Now, we already know consumers are cutting back while the travel's been red hot. Anybody who's taken a vacation lately knows that it's a lot more of a pain in the neck than it was before the pandemic.
The House of Pain.
Prices are high, delays are long, chaos is standard. We know the U.S. economy has been surprisingly resilient despite some real soft spots, but the rest of the world is in real sad shape. All of this works against high oil prices. But forget demand for a second. Let's come at this from the supply side. Think about how oil got to the triple digits in the first place. Garner points out that most of this year's oil rally was a response to international sanctions on Russian crude. Russia's invasion of Ukraine didn't disrupt the oil market by itself. The sanctions did. However, by all accounts, the Russians have been able to circumvent those sanctions by selling oil to China and, more importantly, India. See, that oil didn't just vanish. It didn't get locked up in Russia. It just got rerouted. At the same time, we're hearing rumors after rumors, another Iran nuclear deal, which could potentially bring millions of barrels of production back on the market. Plus, Garner notes, the U.S. rig count, which comes out on Fridays, has finally started to pick up steam. That is unexpected. Our domestic producers have been incredibly disciplined because they don't want to flood the market with supply and then push the price of oil down. But when oil stays this elevated this long, sooner or later, someone's going to start drilling.
That was easy.
Now, take a look at this West Texas Intermediate crude. I think this is a very important chart because you're going to see numbers like you haven't seen in a long time. In the past, Garner predicted that oil would eventually return to its pre-Ukraine trading range. If not for the war, she thinks it would have struggled to break out above the low 90s, which previously acted as a ceiling of resistance. Okay, so you can tell this is where she thought that oil would be stalled. Oil's now back to the low 90s after a brief dip to the high 80s late last week. As Garner sees it, crude has already returned to its historical trading range, and if we get another breakdown below 90, she wouldn't be surprised if that opens the door to an eventual decline way back to $60. So in other words, forget this. She's talking this. That's the historical comfort level for oil prices. It also marks the downtrend line from oil's highs in 2008. So she's taking a longer-term view. You can see that that's symmetrical. Wherever oil might be headed, though, Garner's confident this will be a wild ride. She expects a ton of volatility here. Traders are going to love this. Long-term, though, she sees the oil headed lower. That's about what you'd expect during a Fed-mandated slowdown, especially now that the central banks around the world are also tightening. However, short-term, Garner wouldn't be surprised if we get a nice bounce. That's what I want you to keep in mind, because that's the next thing that she thinks is a bounce. She thinks oil's approaching a price point where buyers are going to start looking for bargains. Plus, it could trade up on any negative headline about the Iranian negotiations faltering. It's possible we've already found that level, considering today's bounce, which was a surprise, because oil started the day down. But even if oil has another leg down, Garner sees buyers stepping in somewhere near 85 a barrel, possibly 80 if things get ugly. Again, she's only predicting a short-term move here, a bear market bounce that can give you a $10 to $12 gain. But that's not nothing. A lot of people would trade that in an instant just to get that gain. I know that if you own some of the major oils, you're going to see a nice run there. And some of the Permians, too. What makes her think that a bounce is imminent? And the bulls will want to hear this. So take a look at this monthly chart of West Texas crude with the Commodity Futures Trading Commission Commitment of Traders data. That's the so-called COT report, okay? She uses that quite a bit. It's been very good for her. The line we're watching is the green one, okay, which shows you the net position of large speculators, meaning money managers. Garner points out that these large speculators have already unloaded nearly half of their net long positions in the oil futures. Right now, they're net long by about 200,000 futures contracts. In the past, whenever the net long position gets down to this level, oil tends to bounce. And here's what she's thinking. Okay, bounce, bounce. So therefore, she's thinking bounce. That's very important because a lot of people were kind of flummoxed that we didn't go continue there. You're going to get your chance to get out if you want to. We're thinking about that with the way for the Charitable Trust. We're making that decision right now based on Carley's work. Now, I want you to check out, this is the chart of the seasonal pattern in West Texas crude. You can see that historically the oil futures tend to trend sideways to higher in the late summer and early fall. But Garner thinks this move will be temporary, in part because the seasonal pattern turns really ugly in August. So remember, you got to skedaddle if you get to this point. And that's part because the fundamentals have got much tougher on oil, even as you don't hear a lot of the analysts saying that. Now, when you zoom in on the daily chart, oil has multiple support levels that can potentially trigger a sizable bounce before the downturn resumes. Crude was trading in the mid-high 80s before the sanctions on Russia catapulted it into the stratosphere. Garner says the sanctions pivot line currently sits at around $87. Sure enough, that's the level we bounced from late last week. In other words, there's a good chance we're in the middle of Garner's temporary bounce right now, which would take us back to here. Although she wouldn't rule out another near-term pullback to the mid to low 80s. As long as oil support in the mid-80s holds, then Garner believes we could see a run. This is where I might want to sell some for the trust. Anywhere from 97 to 102. Before the move sputters, though, and she thinks that we need a positive change in the fundamentals to get oil back to the next salient resistance around 110. In other words, the daily chart is moderately bullish. However, when this rally hits, Garner's adamant that you can't view it as a resumption of the bull market from earlier this year. Oil peaked 2 months ago. The raging bull market is gone. It's over. It's kaput. Instead, Garner recommends us using any short-term strength to lighten up on your oil exposure, which is what we're going to do for the CNBC Investing Club, because longer term, she thinks it's in trouble. Bad news for oil investors, but very good news for the Fed, which is finally making progress in its fight against inflation, as we saw from today's better-than-expected CPI numbers. In time, Garner sees U.S. Treasuries headed back up in price, too. This is a price level, okay? Up means lower rates. Remember, oil has already unwound the invasion trade. But if you look at the chart of the 10-year, it's still a long way from pre-war levels. Currently, the 10-year yields just under 2.8%. Garner wouldn't be surprised if it goes back to excuse me, to 2% or even lower as the price recovers. Here's the bottom line. The charts, as interpreted by Carley Garner, suggest that oil could be due for a short-term bounce, but over the next few months, she only sees it head lower, possibly much lower. That's exactly what the Fed needs to see. Let's go to Stacy in North Carolina. Stacy.
Thanks, Jim, for taking my call. I love your show, man. I appreciate what you do. The stock I'm calling about today is the 52-week low. I mean, its 52-week low is 137. 52-week high of 288. It's currently at 217 today and has a 9.33% yield. The stock is Pioneer Natural Resources, ticker PXD. Is it a buy?
I'm going to make it easy.
Buy.
Okay, this pitch I'm trying to make much larger for my Charitable Trust. It actually yields 15%, and Scott Sheffield is fantastic. I'm the only person on TV who's actually trying to stifle a sneeze. But those other guys never sneeze. What do they do? Have a catnip or something? What do they do? Anti-catnip. But anyway, I like Pioneer very much. Actually, it's the cheapest of the oil companies that we follow. We've been building a position for the Charitable Trust, and I think it's a buy, and I think it can go up to 250. All right, the charts, as interpreted by commodity expert Carley Garner, who, by the way, remember, called a top at 120, suggests that oil could be in for a short-term bounce. But ultimately, she thinks sell. Because oil's headed much lower. Now, much more mad money hit. The software space has turned into an M&A haven. So I'm breaking down the recent major deals and sharing all you need to know. Then the Elon Musk Twitter saga continues. What does it tell us about the market, the Delaware court, and what I think is ultimately going to happen. I'm going to give you my take, and you're going to want to hear it. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Sneezer Cramer.